I hope you don't feel that I am pessimistic when I present information to you about negative market circumstances, be it the economy, earnings, or a potential downturn in the stock market. I am just doing this to keep you from making mistakes. One would think that after two major market corrections of over 50% within the last 2 decades, investors would have a better appreciation for how much time it takes to compound their way out of those losses. While buy and hold investors who stayed true to their strategy over the last 2 decades are perhaps ahead. They lost many, many years of valuable compounding to get back to break even over that time frame. So, let me help remind you. Recently, Michael Leibowitz tweeted a chart that highlighted the issue of the time required to get back to even. This tweet and graph was a little reminder that markets spend a significant time declining and then retracing those declines just to get back to break even. These can be long periods of time when investors are not compounding their wealth. So, is this message fear-mongering? Well, if presenting factual data and highlighting the certainty of market cycles is fear-mongering, then maybe it is. However, investors may want to consider the current valuations and the economic underpinnings of corporate earnings. If fear is what it takes to help investors understand the next 5 years will not likely be similar to the last 5 years, then the chart will have served a valuable purpose. But the message will likely be lost on many because either they have never been through a major market reversion, they have only lived through the most recent downturn in 2008 and assume another financial crisis cannot happen in our lifetimes, or they find it easier to passively manage money and blame major drawdowns on the markets. As David Roseberg recently noted, since 2009, nearly 13.4 million individuals have taken on roles in the financial industry. What this suggests is there are many professionals currently promoting a buy and hold strategy who have never actually been through a bear market cycle. In my own experience is the most valuable teacher of investing over time. Severe market conditions have permanent negative effects on an individual's financial goals, their lives, and their families. This is why all great money managers throughout history have all operated under one simple investment philosophy: buy low, sell high. Even the great Warren Buffett once noted the two most important rules of investing. Rule number one, never lose money. Rule number two, never forget rule number one. Okay, you didn't like my first chart. So let's look at the same time frame but show the total real return including dividends of $1,000 invested in the S&P 500 with dollar cost averaging. While the various periods of losing and recovering are shorter than the previous graph, the point remains the same. There are long periods of time investors spend getting back to even, making it significantly harder to fully achieve their financial goals. And note this graph here is in logarithmic format using information from Robert Shiller. And the important lessons to learn are that investors do not have 118 years to invest. Given that most investors do not seriously start investing for retirement until the age of about 35 years or older, most investors just have one market cycle to reach their goals. If that cycle happens to include a 10 to 15 year period in which total returns are flat, the odds of achieving savings goals are significantly diminished. If an investor's 30-year investment cycle happens to end with a major market crash, the result can be devastating. Time, duration, and ending dates are crucially important to expected investor outcomes. More importantly, buy and hold strategies do not consider risks, expected returns, and alternative strategies. Consider that from the year 2000 through 2013, the S&P 500 index, including dividends and inflation, delivered a zero rate of return. From the year 2000 through 2017, the market returned 0.30% more than risk-free treasury bonds. However, to reach that rate of return, which is a spectacular rate of return, I'm sure, it required the expansion of valuation multiples to extreme levels. Equity investors have endured two 50% drawdowns and over a decade of no returns to achieve an 18-year, 30 basis point annualized pickup over bonds. That's an astonishing low return given the risks that are required to reach that level. With current lofty valuation levels, it is possible, perhaps likely, you will wake up on New Year's Day in 2025 and find the stock market that has lagged or barely matched the return of bonds for a full 25 years. As this is plainly shown, markets go through cycles. During these cycles, there are often tremendous opportunities to own stocks. However, these cycles also include periods when risk should be minimized and your greed should be constrained. Be active in the management of your money. Don't fall for the one-size-fits-all mindset of the buy and hold strategy. Manage your strategy and be aggressive when valuations are cheap, but defensive when valuations are lofty, such as current conditions. Investors need to recognize that losses weigh far more heavily in compounding wealth than does chasing returns. Be cautious and stack that cash for the opportunities to come. So for today, that's ChewDog Charts. Thank you.